Welcome to the Deep Dive, where we take your pile of sources, whether they're detailed articles, in-depth research, or even, those intriguing online discussions, and we really try to unearth the most compelling insights, those surprising facts, and the essential aha moments that will get you truly well-informed and fast.
And today, we're embarking on a deep dive into a concept that gets talked about so much it's often misunderstood, yet, while universally sought after: passive income. Our listeners shared their immense curiosity about generating wealth, seemingly with minimal ongoing effort.
Right.
But what does passive truly signify in the context of income? Is it genuinely money for nothing, like the dream suggests, or is there always a significant catch hidden somewhere beneath the surface?
That's the absolute core question, isn't it? For this deep dive, we've gathered a really fascinating stack of sources. We've got everything from the tried and true financial advice offered by institutions like Navy Federal and Bankrate, all the way to the candid, sometimes pretty blunt insights found in various Reddit threads. And we've even taken a journey into the genuinely bizarre ways people have struck it rich, or at least passionately, tried to.
So our central mission today is pretty fundamental. Can you really make money with minimal ongoing effort? Or does that word passive simply mask, maybe, an enormous amount of initial labor? We're going to explore the real definitions, the practical implications of passive income in your financial life. Let's really unpack that.
Okay, let's start right there, unpacking the core concept of passive income itself. Because honestly, that's where so much of the misunderstanding seems to begin. When we hear that phrase, the ideal image that often springs to mind is like money flowing in effortlessly, almost like magic once you've set something up.
Yeah, the dream.
Totally. Our sources certainly speak to this ideal. They define passive income as ways of making money with minimal ongoing effort or investment. After that initial groundwork is fully established, it's fundamentally about creating long-term financial benefits, and frankly, who wouldn't be captivated by that prospect?
But what's truly fascinating here, and often I think overlooked, is that while the ideal suggests minimal ongoing effort, the practical reality, well, as a very insightful Reddit thread explicitly points out, it's far from no work.
Right.
It's absolutely crucial to understand this upfront work clause that accompanies almost every genuine passive income stream. That Reddit discussion clearly states, and I think this is key, that it requires a lot of unpaid work up front to successfully create a sustainable income stream.
A lot of unpaid work.
A lot. So the discussion isn't really about if an income source is passive, but rather, how passive it truly is. And what does that initial, often substantial investment of time and effort really look like? It's definitely more of a spectrum than a simple yes or no.
That distinction, that passive, still means a lot of unpaid work up front. That's such a critical clarification. It really shatters that kind of pervasive illusion for many people, doesn't it?
It really does.
I saw one Redditor, for example, shared how they dedicated nearly 3 years to meticulously building their clientele and refining their systems for, I think it was some kind of service.
Wow, 3 years.
Yeah. Now, they earn around, say, $1,500 a month just by responding to order emails. That's a powerful illustration of that unpaid work up front principle, really, in action.
Definitely. That's the grind before the reward.
And it's not just about accumulating wealth for its own sake either. It's about something far more profound, really.
Absolutely. If we connect this to the bigger picture, the goal isn't solely about wealth accumulation in a purely numerical sense. Navy Federal Credit Union and others we looked at highlight that the deeper purpose of establishing passive income is really about creating freedom and options in your life.
Freedom and options, yeah.
It's about cultivating that financial breathing room, which could potentially allow you to reduce your active working hours, maybe embrace a more fulfilling lifestyle, pursue hobbies you've always put off, or spend truly invaluable time with family. It's about transforming your financial reality and opening up new possibilities that extend far beyond just adding zeros to a bank balance. It's about reclaiming your time, fundamentally.
But, with all this appealing talk of financial freedom and reclaiming time, it's incredibly easy for the term passive income to become distorted, maybe even weaponized sometimes.
Right.
Our sources really underscore the prevalent myth and the common misconceptions that just seem to swirl around it.
Oh, definitely.
First and foremost, and this cannot be stressed enough, passive income is absolutely not a get-rich-quick scheme, even though the term has unfortunately been completely hijacked by those kinds of promises.
Yeah, you see that everywhere online.
Exactly. It's fundamentally not about avoiding work entirely. As that Redditor emphasized, some new self-help gurus or online personalities might claim no effort is involved, but that's just not grounded in reality for legitimate, sustainable streams. It's misleading.
Which raises a really important question for you, the listener. What isn't passive income? Well, your regular 9-to-5 job, for instance, or even a second job you take on, that fundamentally doesn't qualify.
Right, that's active work.
Exactly. Any income derived from material involvement, meaning you need to consistently show up and do the work, is, by its very definition, active income, not passive. The Bankrate source is very clear on establishing this critical distinction. If your direct labor is required for the income to keep flowing, it's active. Simple as that.
And it's not just about direct employment either. This might surprise some people, but not all investments automatically qualify as passive income.
Yeah.
For example, if you own non-dividend paying stocks or, say, unstaked cryptocurrencies, meaning they're just sitting there in your wallet, not actively earning interest or rewards, they won't generate passive income for you.
That's a good point. Appreciation isn't income in the same way.
Precisely. Unless those assets are specifically designed to pay out dividends, interest, or some form of continuous distribution, they're simply not creating that desired continuous flow of money. And the IRS, particularly in the U.S. context, introduces a really key nuance here.
Taxes. Always fun.
Always. It generally does not consider all portfolio income as passive for tax purposes. Income from interest, dividends, or gains on investments is often called portfolio income, and maybe surprisingly, it's not always considered passive under tax law, particularly if you're deemed to be materially participating in the business generating that income.
Materially participating. Okay.
Yeah, and this matters because it affects things like the passive activity loss rules. These rules basically determine if you can deduct losses from these activities against your other income, like your salary. It's a complex area, honestly, that can significantly impact your tax bill.
So professional advice is probably a good idea there.
Absolutely. It's always wise to consult a qualified tax professional for specific advice tailored to your situation. They understand the labyrinth.
Definitely. There's also the significant risk of divided focus. When you try to build multiple passive income streams simultaneously, maybe you get excited about a few ideas.
Yeah, spread yourself too thin.
Exactly. There's a real danger that your existing streams, the ones you've already worked hard on, might actually go to zero or yield significantly less. This happens because your attention and resources just become spread too thin, and your overall management responsibilities inevitably increase.
Right.
While diversification is generally key to balancing risk and maximizing returns across your investment portfolio, that's standard advice, it requires incredibly careful execution here to avoid diluting the performance of your established, hard-won streams. It's a very delicate balancing act.
Okay, so with those crucial definitions laid out, the upfront work principle hammered home, and the important caveats now thoroughly established, let's truly dive into some of the legitimate viable paths to passive income that our sources detail pretty extensively.
Let's do it.
We'll begin with what many consider the bedrock of passive income, investment-based strategies. First up, dividend stocks and dividend reinvestment plans, widely known as DRPs. That's a classic for a reason, right? But it comes with its own set of nuances.
Absolutely. The strategy here is quite straightforward in principle. You invest in established companies, usually larger ones, that consistently pay out a portion of their profits to shareholders as dividends. D-TRIPs, the reinvestment plans, take this a powerful step further by automatically reinvesting those dividends back into purchasing more shares of the same stock.
Compounds.
Exactly. It creates a compounding effect, accelerating the growth of your investment portfolio over time. It's like planting a tree and then using its fruit to plant more trees, expanding your orchard without constant manual effort. Theoretical.
Okay, the pros are certainly appealing there. Potential for higher overall returns compared to just holding cash maybe, and of course that regular income stream flowing into your account. Seems good.
It can be, but the cons are equally vital to understand. Stock prices are inherently volatile. They're tied directly to broader market performance, economic news, interest rates, and individual company health. Our sources highlight that value stocks, in particular, can face substantial uncertainty. These are typically companies the market considers undervalued, often because they have high financial leverage, meaning they've used a significant amount of borrowed money to finance their operations.
Okay, so more debt means more risk.
Generally, yes. While leverage can amplify gains during good times, it also amplifies losses during economic downturns, making them a potentially riskier bet for someone seeking truly stable passive income. So it's always a balance of potential reward against market fluctuation and that inherent company risk.
Got it. Okay, next on the list, Bonds and bond ladders. Explain this one.
Right. The basic strategy involves lending money either to a government, like buying U.S. Treasury bonds, or to a corporation by buying their corporate bonds. In return, you receive a fixed interest rate over a specified period.
Like an IOU with interest.
Pretty much. A bond ladder is a more sophisticated but often effective approach. You stagger the maturity dates of multiple bonds. For example, you might buy bonds that mature in 1, 2, 3, and 4 years.
Okay.
As each bond matures, you get your principal back, and you can then reinvest it into a new, longer-term bond at whatever the prevailing interest rate is at that time. This helps reduce interest rate risk because you're not locking all your money into a single rate for a long period, and it provides regular access to your principal as the rungs of the ladder mature.
Okay, that makes sense. So the pros here are the promise of regular, often predictable income, which can be a comforting contrast to the ups and downs of stocks.
Right, more stability, potentially.
Well, what are the cons?
Well, corporate bonds carry default risk. That means the company you've lent money to might, in a worst-case scenario, actually be unable to pay you back. It happens. And if overall interest rates rise after you've purchased your bonds, the market value of your existing bonds, which pay that lower fixed rate, can decrease if you try to sell them before maturity. So diversification across many different bonds from various issuers and maturities is absolutely essential to mitigate that single bond risk or interest rate risk.
Right, don't put all your eggs in one bond basket.
Never a good idea.
Okay, following that, we have high-yield CDs, certificates of deposit, and high-yield savings accounts. These sound maybe a bit more straightforward.
They generally are. The strategy here is relatively simple. You deposit money into accounts that offer higher interest rates compared to your standard everyday savings account. Typically, especially with CDs, this is in exchange for locking up your funds for a set period, could be 6 months, a year, 5 years.
So less flexibility, maybe.
Exactly. The longer the term for a CD, generally, the higher the interest rate you might earn. High-yield savings accounts offer more flexibility, but usually slightly lower rates than CDs.
The big advantages here seem like peace of mind, maybe. Unlike stocks, the risk is generally much lower, often FDIC insured up to certain limits in the U.S., and the returns are highly predictable. You essentially know exactly how much you'll earn.
Correct. That predictability can be incredibly reassuring for managing your finances and having that breathing room we talked about.
What's the main drawback then?
The main drawback is that these returns are often lower than what you might achieve with other investment types, like stocks or even some bonds over the long term. And your liquidity can be limited, especially with CDs where your money is committed for a specific term, and withdrawing early usually means paying a penalty.
Okay, makes sense. Now, something a bit different. Peer-to-peer or P2P lending? What's the deal here?
Yeah, this one's interesting. P2P lending allows you to basically bypass traditional banks and lend money directly to individuals or small businesses through online platforms. You might have heard of Prosper, Lending Club, or Upstart.
Yeah, I've seen those names.
In return for lending, you earn interest on those loans. The platforms typically handle the credit vetting process, connect borrowers with lenders like you, and manage the payments, streamlining the whole thing.
Huh. So this sounds pretty cool because it diversifies your investment portfolio maybe beyond just stocks and bonds. And in a way, you're directly supporting other people or small businesses.
That's part of the appeal for some people, yes. And you can even start with surprisingly small amounts. I think Prosper.com has like a $25 minimum per loan, making it quite accessible.
But I feel a but coming.
There's always a but with risk.
Yeah.
Slight chuckle. The main con here is the risk of borrower default. Since these loans are often unsecured, meaning there's no collateral like a house or car backing them, if the borrower stops paying, you might lose your investment on that particular loan.
Ouch. Okay, so how do you mitigate that?
Well, it's absolutely crucial to diversify your loans across a significant number of different borrowers rather than putting, say, $1,000 into just one loan. Spread it out.
Like the bond ladder idea, but for loans.
Exactly. It's also wise to thoroughly analyze the historical data and credit scores of prospective borrowers that the platforms provide. They often give detailed profiles and risk ratings. And critically, only invest money you can truly afford to lose. That's paramount for P2P.
Okay, good advice. Now, moving into real estate investments, but maybe sidestepping the direct landlord headaches. REITs, real estate investment trusts, and municipal bond closed-end funds.
Right. So with REITs, the strategy involves investing in companies that specifically own, operate, or finance income-producing real estate. Think shopping malls, apartment complexes, office buildings, data centers.
So you're buying shares in the landlord company, not the building itself.
Essentially, yes, or in companies that finance those properties. Municipal bond closed-end funds are similar but hold portfolios of municipal bonds, which are loans to state and local governments. You're buying shares in a fund that manages these assets for you.
Okay, so the primary pro of REITs seems like getting exposure to diversified real estate portfolios without the need for direct property management. That sounds like a huge plus compared to being a hands-on landlord.
It definitely is for many people. It allows you to participate in the real estate market with much greater liquidity than owning physical property, since REITs are typically traded on stock exchanges.
But the significant con.
They are still subject to market fluctuations, just like stocks. Their value is traded daily on exchanges, so they can go up and down with the market sentiment and economic conditions affecting real estate.
Our sources also mentioned preferred stock here, which sounds fancy. What is it?
Yeah, it's a fascinating hybrid security, actually. It combines features of both bonds and common stock. Preferred stocks typically pay larger than usual dividends, often at a fixed rate, and those dividends usually have priority. They get paid before common stockholders receive theirs if money is tight.
Interesting. Who issues these?
Many REITs, banks, and other financial companies issue preferred shares. It can be an attractive way to earn a passive return, especially for investors who prioritize steady income over potential capital gains from stock price appreciation. They often come with that predetermined dividend payment.
But there's always a catch, right?
Always. Like other market-traded securities, their prices can fluctuate, particularly with changes in overall interest rates. And there's always an underlying risk if the issuing company faces severe financial distress and cannot actually pay its promised dividends. So, thorough research into the company's financial health is absolutely key before investing in preferreds.
Okay, good to know. Now let's talk about the real estate-based passive income that might involve a bit more hands-on work, maybe. Starting with the traditional rental property. This is probably what most people picture first when they hear passive income and real estate.
Absolutely. The strategy is straightforward on the surface. You purchase property, rent it out for monthly income, and hopefully benefit from the property's value appreciating over the long term.
Seems simple enough.
Seems simple, but this is precisely where the word passive often gets really tricky, blurring the lines considerably. Being a landlord is, by its very nature, not entirely passive. It involves ongoing management responsibilities.
Yeah, the 3 Ts. Tenants, toilets, and trash.
Chuckles. Exactly. Handling maintenance requests, finding new tenants when units become vacant, dealing with late payments, potential damages, all the inevitable challenges that come with property ownership. Our sources explicitly state that if you devote too much time to actively managing the property, say if it becomes your full-time job, it might even constitute active participation in the eyes of the IRS.
And that means?
It means it might not qualify as passive income for tax purposes, which can impact how you can deduct losses against other income. So it's definitely a spectrum of involvement.
So how does someone typically get started with traditional rentals if they're willing to take on some of that?
It's often suggested to start small, maybe with a single-family home or a small multi-unit property like a duplex where you might even live in one unit and rent out the other.
Okay.
Yeah.
But the risks are significant, right? We shouldn't underestimate those.
Absolutely not. You've got late rent payments, potential property damage, extended periods where you can't find tenants leading to vacancies and no income, and broader economic downturns where tenants might struggle to pay rent or market rents could drop significantly. There's also the risk, especially lately, that your rental income might not even cover your expenses: mortgage, property taxes, insurance, maintenance, particularly if you bought the home at a very high price when mortgage rates were low, and now taxes or maintenance costs are rising.
So how can you make traditional rental properties more passive then?
The key is delegation. You can significantly reduce your active involvement by hiring a professional leasing agent just to find and screen tenants. Or, even better, for pure passivity, hire a full-service property manager.
Right, they handle everything.
They handle pretty much everything: collecting rent, coordinating repairs, dealing with tenant issues. This shifts a lot of the day-to-day active responsibilities off your plate, pushing it much closer to a truly passive income stream. But of course, it comes at a cost, usually a percentage of the monthly rent.
Okay, that makes sense. Pay for the passivity. Now, another avenue for real estate, one that might truly embody the passive ideal for many, is real estate crowdfunding. What's this about?
Yeah, this is a newer model really enabled by online platforms. The strategy here is to pool your funds with other investors through platforms like Fundrise or CrowdStreet, for example. You invest collectively in larger real estate projects like apartment complexes, commercial buildings, or development projects that would typically be way out of reach for an individual investor.
So you own a small piece of a big project.
Exactly. You're buying into a fractional ownership of a larger portfolio or a specific development.
What are the benefits there?
The significant benefits are getting exposure to real estate ownership, potential appreciation, rental income distributions, without any of the direct property management hassles, none of the tenant calls. And you don't need the massive capital outlay required to buy a whole property yourself. It allows access to large, often professionally managed portfolios.
Okay, sounds good. What are the cons?
Well, you still need good judgment on which specific projects or funds to buy into. It's definitely not a set-it-and-forget-it decision initially. You need to meticulously read all the offering prospectuses to understand the specific risks, the fees involved, the projected returns.
Due diligence is still key.
Absolutely. And remember, real estate itself is susceptible to economic downturns, especially given its high reliance on debt financing. Plus, your money can often be locked up for long periods in these deals, sometimes years, which significantly impacts your liquidity compared to, say, selling a stock.
Right, you can't just cash out easily.
Okay.
And then there's the more granular approach, maybe renting out specific assets you already own,
Right.
like Airbnb.
Exactly. Think short-term home rentals via platforms like Airbnb or Vrbo. The opportunity is that you can list your spare room, a vacation home you own, or even your entire primary residence when you're away. You set your own terms for pricing and availability, and you collect the payments. For longer-term tenants, this can involve minimal extra work after the initial setup and vetting.
What's the risk profile like there?
Well, the financial downside, the initial investment, is relatively low compared to buying a whole separate investment property. But the significant risk involves having strangers stay in your personal space. There's the potential for property damage, defacement, parties, or even theft of property or valuables. You have to weigh that comfort level.
True. And our sources mentioned even smaller things.
Yeah, less common but perfectly viable options include renting out a parking space you own but don't use in a busy area, or even useful household items. Think power tools, high-end kitchen gadgets, musical instruments, camping gear. Platforms are popping up for this kind of item sharing too. It's about monetizing underutilized assets you already possess.
That's clever. I also found it interesting, the idea of managing someone else's rental, like their Airbnb, for a percentage of their earnings.
Right. Now, that's decidedly your active income in that scenario. You're doing the work, but you're providing them a crucial service that makes their income stream much more passive. It's a symbiotic relationship.
And that model could potentially scale for you, right?
Yeah,
If you manage multiple properties, it becomes a real business.
absolutely. You could leverage your time and expertise to build a larger property management business, all focused on enabling passive income for others while generating active income for yourself.
All right, let's pivot now. Let's talk about digital and creative passive income ideas. These often seem to involve a really high upfront effort in terms of creation, but once established, they can offer incredible, almost infinite scalability. Things like writing an ebook or creating an online course.
Exactly. The core strategy here is to create a piece of digital content, whether it's an educational course, teaching a skill, a detailed guide, a novel, whatever, that can be sold repeatedly, potentially to millions of people, with virtually zero additional cost per unit once it's actually made.
The marginal cost is basically zero.
Pretty much. The opportunity is not just in delivering value and earning direct revenue from sales, but also potentially in driving traffic to your other offerings. Maybe you have audio-video courses, a personal website with consulting services, or even live seminars. It acts as a powerful funnel, and the scalability for digital products is, well, truly infinite compared to physical goods.
Okay, sounds amazing.
Yeah.
What's the risk, though? What's the hard part?
The risk is substantial. Make no mistake, your content needs to be very strong, genuinely high quality, and probably niche enough to resonate deeply with a specific audience if you want to build a real following. It can't just be mediocre.
Right.
And crucially, it requires significant ongoing marketing efforts. Just creating it isn't enough. You need to maintain an existing website, run promotions, maybe try to get media appearances, build a social media presence. You could easily put in a lot of unpaid work up front, as we keep saying.
Yeah, back to that again.
With potentially very little back for your efforts, especially at first. And as one source notes, the real benefits, the sustainable income, often come from creating a series of products or content, not just a single one-off hit. It's about building a body of work, an ecosystem.
Okay. Similarly, selling photography online falls into this category too.
Yes, very similar principle. The strategy involves capturing high-quality images once, editing them, keywording them properly, and then selling the same photos repeatedly through stock photography platforms like Getty Images, Shutterstock, or Alamy.
So you earn royalties each time someone licenses your photo.
Exactly. This offers scalable effort. Once the photos are taken, edited, and uploaded, which is significant work in itself, you continue to earn royalties potentially for years each time someone licenses your image for their website, marketing materials, whatever.
Creating a blog or a YouTube channel also fits this mold, I suppose.
Definitely. The strategy is to turn a passion, an expertise, or maybe just a unique perspective into engaging content, whether written or video. You then generate income primarily through advertising revenue displayed on your site or videos, or through direct sponsorships from brands.
The opportunity seems huge there, leveraging free or very low-cost platforms like WordPress or YouTube to reach a potentially global audience.
It is huge, and having a unique voice or focusing on a specific niche can really help you build a loyal following and eventually attract those lucrative sponsors who want to reach your audience.
But the risk, again, I imagine it's the time.
Immense time investment. It requires a significant amount of time and consistent effort to build out a suite of engaging content and draw a consistent audience. It doesn't happen overnight. And there's the distinct possibility, particularly in the super fast-paced world of online trends.
Things change fast.
So fast. Your audience can potentially flee to the next popular influencer, trend, or social media platform. Maintaining relevance requires ongoing effort, adapting, creating fresh content. It's rarely truly passive in the set it and forget it sense.
Okay. Selling designs online, like for t-shirts, mugs, digital art, or creating a mobile application, those seem similar too. That heavy initial creation phase for potential ongoing sales.
Exactly the same model. High upfront work, potential for long-term payoff if it catches on and you market it well.
Then there's affiliate marketing. Explain that one quickly.
Affiliate marketing is where you earn a commission by promoting and selling other companies' products or services. You include special tracked links in your content, blog posts, videos, emails, and if someone clicks your link and makes a purchase, you get a cut.
So you need an audience first.
Absolutely. This requires you to have a strong medium, like that popular website, a social media channel, or an engaged email list, and a good strategy for genuinely recommending products your audience will trust and value, guiding them towards purchases without being overly salesy.
Okay. And of course, sponsored posts on social media. We see this all the time.
All the time. If you manage to cultivate a strong, engaged following on platforms like Instagram, TikTok, YouTube, whatever, brands will eventually notice and may directly pay you to feature their products or services in your content.
The opportunity there is obvious. Monetize your existing social media presence, turning your influence, your online personality, into an income stream.
But here's the catch-22, the core challenge we see again and again with these creator models.
What's that?
You need a truly large and genuinely engaged audience to get meaningful sponsored posts, the kind that generates substantial income, not just free products. But building that audience, that is a significant, incredibly time-consuming effort with absolutely no guarantee of success.
Right. You could spend years trying.
Exactly. Hundreds or thousands of hours chasing trends, creating content, engaging with followers, all hoping for that breakthrough sponsorship deal that might never materialize. It's a tough gig.
An interesting alternative mentioned in our sources is actually buying an existing blog or online business.
Yeah, this is like taking a shortcut, potentially. It essentially gets you in the game today rather than tomorrow by providing you with an established platform, maybe some existing content, and hopefully an already built audience, and maybe even some revenue streams.
So you skip the initial building phase.
You skip some of it, yes. You can then leverage your skills. Maybe you're great at writing or SEO or marketing to implement improvements, better content, higher operational efficiency, new marketing strategies, all aimed at achieving greater profitability than the previous owner.
What's the risk there? Buying someone else's creation?
Well, an online business isn't always very liquid, meaning it can be hard to sell quickly if you need to. And you really need to gauge the market effectively to ensure you're buying something with potential, not a sinking ship. Plus, you still need to produce content or manage the business effectively to keep attracting readers or sponsors. It requires real business acumen, not just creative skills.
Got it. And then there's the slightly more peculiar anecdote from the sources, quite niche. about a student who apparently filled a web domain with uh, adult Japanese animation content, often called hentai,
Okay.
and reportedly made a substantial amount of money purely from the ad revenue generated from the high traffic to the site.
Wow. Okay. Well, that certainly highlights the diverse and maybe sometimes ethically ambiguous range of niche digital opportunities out there for passive ad revenue. It shows that creativity, or perhaps just a keen eye for untapped, maybe controversial online demand, can manifest in some pretty unexpected ways.
Definitely unexpected. Okay, beyond purely digital or investment strategies, some traditional business models can indeed transition into being highly passive for their owners if they're scaled effectively through smart management and delegation. Take flipping retail products, for example.
Right. The initial opportunity there lies in leveraging price differences, finding discounted merchandise, maybe from clearance sales, store closings, liquidations, and then reselling it online on platforms like eBay or Amazon for a profit.
Sounds like work, though.
Oh, it is initially. The risk here is the upfront hustle to find a reliable source of profitable products, which is very active work. And you need significant upfront cash investment to buy the inventory before you sell it.
Mm-hmm.
You also really need strong market knowledge to avoid buying stuff at too high a price or acquiring products nobody actually wants. Otherwise, you're just stuck with merchandise. You might have to sell at a loss. But if you establish a reliable supply chain, maybe systems for listing and fulfillment, perhaps even hire people to help, it can become less hands-on over time.
Okay. Now, intellectual property. This seems like potentially one of the most powerful and truly long-term passive income generators, doesn't it?
Absolutely. If you can create and protect valuable IP, the potential is huge. One fascinating anecdote from our sources mentions someone who became incredibly wealthy simply by inventing the specific way Kleenex tissues are folded inside the box so they pop up one after another.
Just the fold. Seriously.
Just the fold, a brilliant, simple mechanical patent that likely led to ongoing royalties for years and years.
Wow. Or consider the person mentioned who patented the use of RFID technology, those little radio chips in poker chips, right out of high school.
Yeah, incredible foresight.
And then sold millions of these chips to casinos worldwide. These are incredible examples of how a single invention or a cleverly secured patent can generate massive, truly passive income over an extended period once that initial creative and legal work is done.
It almost makes you want to look at everyday objects completely differently, doesn't it?
Totally. Like, is there a $1 million patent hidden in my kitchen drawer somewhere?
Chuckles, exactly. It's often that blink and you miss it simplicity or a novel application of existing tech that can be the most lucrative. And it certainly challenges the idea that passive income always requires huge capital or complex financial maneuvering.
Right. Even manufacturing niche products. The sources mention things like costumes for the elf-on-the-shelf doll, or even the humble strings used in tea bags.
Yeah, those businesses likely started out as incredibly active, hands-on endeavors. Someone had to design them, source materials, set up production, find buyers.
A lot of work.
A ton of work. But, as the story suggests, if they are successfully scaled, meaning you hire dedicated teams to handle the hands-on production, the marketing, the distribution, they can lead to significant wealth that becomes genuinely passive for the original owners who then just oversee the operations rather than doing the daily labor.
Okay, let's shift gears a bit and talk about the less glamorous, but equally critical aspects of wealth generation. The inherent role of risk and the pervasive, often confusing complexities of taxation. Our sources consistently highlight that all income streams, no matter how passive they seem on the surface or how brilliantly conceived, inevitably carry some degree of risk. There's really no truly risk-free path to wealth, is there?
Absolutely not. That's a fundamental truth. Market performance can be incredibly volatile, especially for investments in stocks where prices can swing dramatically based on economic news, interest rate changes, or specific company performance. Defaults are always a possibility in lending, as we discussed with P2P platforms and even corporate bonds. And economic downturns can significantly impact real estate, affecting rental income, property values, tenant stability. It's never a guaranteed path. Due diligence, understanding the risks involved, and ongoing monitoring are paramount for any serious investor seeking passive income.
Then there's cryptocurrency investing. This is an area that's been massively hyped, filled with stories of overnight crypto millionaires.
Oh, the hype is deafening sometimes.
But the reality, as our sources emphasize with some pretty strong warnings, is that crypto investing is highly volatile, largely unregulated in many jurisdictions, and inherently very, very risky. It's often described as a kind of Wild West scenario that can lead to incredibly rapid gains, yes, but also absolutely devastating losses.
For beginners looking at crypto, the key advice here is paramount and honestly cannot be overstated. First, seriously consider starting with paper money or simulated trading platforms. Practice, understand the market dynamics, test strategies without risking any real capital first.
Learn before you leap.
Exactly. Second, only ever invest money you can truly afford to lose, because the possibility of losing your entire investment in crypto is terrifyingly real. Third, and critically, our sources vehemently advise avoiding leverage trading, which is also known as futures trading in the crypto space.
Okay, what's that?
Leverage trading means you're essentially borrowing money from the exchange to make bigger bets. It magnifies potential profits, but it magnifies potential losses even more drastically unless you have an extremely deep understanding of the complex mechanics and the significant liquidation risks involved, where the platform automatically closes your position and you lose everything you put into that trade. Just stay away.
So stick to simpler stuff, maybe.
For most people, yes. Always do your own exhaustive research. Understand the technology, the specific project or coin you're investing in. Don't just buy something because it's hyped online or you have FOMO, the fear of missing out. And definitely don't blindly follow others' advice on social media or forums. Think for yourself.
That distinction between spot and futures trading in crypto seems really important here, and probably a point of confusion for new investors. Can you clarify?
Yeah, definitely. Spot trading is relatively straightforward. It's buying and selling the actual cryptocurrency asset, like Bitcoin or Ethereum, at its current market price. You own the underlying coin or token directly.
Okay, simple buying and selling.
Right. But futures trading involves derivatives. You're essentially speculating on the future price of an asset without actually owning it right now. You're betting on whether the price will go up, that's called going long, or if the price will go down, that's going short.
So it's purely a bet on price direction.
Precisely. This means with futures, you don't actually own the underlying cryptocurrency. And it's extremely risky, especially with leverage, because your position can be liquidated. That means the exchange automatically closes your trade and you lose your entire initial investment in that specific trade if the market moves sharply against your prediction. It can happen incredibly quickly, sometimes within minutes or even seconds in volatile markets.
Wow. Okay, sounds like something to approach with extreme caution, if at all. Similarly, commodity trading, things like steel, iron ore, oil, agricultural products, that sounds complex too.
Ugh, incredibly complex. Prices for commodities are influenced by a vast array of global factors. Overall economic performance, global supply chains, industrial demand, geopolitical events like wars or instability, and political factors like trade wars, tariffs, or government regulations. It requires extensive market analysis and a really deep understanding of global economics and specific industry dynamics, not for the faint of heart.
Right. And finally, let's circle back to taxation nuances, particularly in the U.S. context, as it significantly impacts your net passive income, what you actually keep.
Yeah, the government always gets its share.
The U.S. tax code makes these complex distinctions between various types of income. You've got active income, which is typically from your labor or direct business involvement, like your salary from a job. Then there's passive income, which the IRS generally defines as income derived from activities where the taxpayer is not actively or materially involved. Think ordinary rental income from properties where you've hired a manager, or income from limited partnerships where you're just an investor.
Okay, less hands-on.
Exactly. And finally, there's portfolio income. This includes things like interest earned on savings accounts or bonds, dividends from stocks, royalties from intellectual property, or capital gains when you sell investments for profit.
So, three main buckets: active, passive, portfolio.
Basically. But it's a profoundly complex area. And the IRS, for example, generally does not consider all forms of portfolio income, like dividends and interest, as passive for certain tax purposes, especially when it comes to deducting losses.
Okay, so the definition matters for deductions.
Precisely. This isn't just about categorizing income neatly. It specifically impacts things like those passive activity loss rules we touched on earlier. These rules essentially determine whether you can deduct losses from your passive activities, say a rental property that lost money 1 year against your active income, like your salary. Often, you can only deduct passive losses against other passive income.
Which could mean a higher tax bill if you have passive losses but no passive gains to offset them against.
Exactly. If you have significant passive losses, these rules can limit your ability to offset other income, potentially increasing your overall tax liability substantially. So for specific advice on how these intricate laws apply to your unique financial situation, it is always, always wise to consult a qualified tax professional. They can navigate the nuances that most ordinary individuals, frankly, would find completely overwhelming.
Sound advice. Okay, now let's broaden our view even further, maybe beyond just the defined strategies and tax implications. Our sources reveal that wealth generation sometimes involves elements of just pure chance, significant inherited advantage, and even some truly unconventional, often highly active hustles that can be easily mistaken for passive or easy money.
Yeah, the luck factor is fascinating. One of the most striking examples of pure chance, almost like winning a lottery you didn't even realize you'd entered, is that phenomenon of Bitcoin windfalls.
Right, those early adopter stories.
Exactly. Several anecdotes highlight individuals who bought Bitcoin way back, maybe on a whim, maybe just for fun when it was practically worthless, perhaps forgot about the digital wallet completely.
Lost the password.
Yeah. And then years later, they rediscovered it and found they had become incredibly wealthy, sometimes multimillionaires, when Bitcoin's value just exploded unexpectedly. This truly underscores how pure serendipity, just being in the right place at the absolute right time, can play a massive, unexpected role in wealth accumulation, especially in these nascent, highly volatile markets where the future value is almost unimaginable at the outset.
It really is like finding a forgotten treasure chest. Other examples of truly fortuitous gains popped up too. Someone receiving a large insurance settlement after being hit by a car unfortunate event, but they then shrewdly used that money as a down payment for a highly profitable piece of real estate.
Wow, turning misfortune into fortune.
Or the story of someone who found a particularly ugly oil painting for free, maybe at a yard sale or left behind somewhere, only to discover later, after getting it appraised, that it was some kind of lost masterpiece worth a fortune.
Incredible. Like Antiques Roadshow dreams.
Totally. Even a bizarre incident mentioned of a payroll error from an old job, where money was accidentally direct deposited for months after the person left, and it was never reclaimed. That unexpected windfall apparently allowed one person to be financially secure for a couple of college semesters. These are truly lucky breaks, pure happenstance.
Then there's the morbid investment anecdote.
Ah, yes, that one was unique. An individual who invested in a company that operates in the life settlement market. Basically, these companies give elderly people, often those who are terminally ill, a portion, say, a quarter of their life insurance policy's face value in cash up front before they die. The company then takes over paying the premiums and becomes the beneficiary. When the person eventually passes away, the company collects the full death benefit. It's a very passive, long-term, and admittedly quite morbid, as the source called it, income stream based on actuarial calculations.
Oh, wow. It's certainly passive, but yeah, has a strange feel to it. Okay, and then there's what we might call the ultimate passive income, a phenomenon that sparks considerable societal debate. Inherited wealth.
Right. Figures like Charlene de Carvalho Heineken, the daughter of Freddie Heineken, inherited billions, becoming one of the richest people on the planet without having to do a single contribution or effort of her own, purely through lineage.
Just born into it.
Exactly. This is wealth granted entirely by the societal and legal system of inheritance, not through personal endeavor, risk-taking, or innovation on her part.
And this form of wealth acquisition, inheriting vast fortunes, sparks significant societal debate, doesn't it? About whether such extreme riches are a fair reflection of the contribution made to society.
It absolutely does, especially when you consider the role that state-granted intellectual property protection like patents and copyrights plays in the fortunes of many modern tech billionaires, like Bill Gates was mentioned. These are, in essence, government-backed temporary monopolies that allow innovators, or the companies they build, to control and profit exclusively from their creations for extended periods.
So the argument is that wealth purely from their genius or also from the system granting that monopoly?
That's the core of the debate. It raises profound questions about the inherent fairness of a system that allows such vast, sometimes seemingly unearned fortunes, whether through inheritance or protected IP. And this leads directly into discussions about policies like a wealth limit, progressive wealth taxes, or various forms of wealth redistribution as potential policy choices to address that inequality.
Okay. Now moving on to unconventional but often very active hustles. These sometimes get mistakenly lumped in with passive or easy money, maybe just because they fall outside traditional 9-to-5 employment.
Yeah, like the amusing story of the tumbleweed entrepreneur. Apparently, a student started a tumbleweed rental business for movies being filmed in the desert.
Renting tumbleweeds. Serious.
Seriously. And eventually, they gained a virtual monopoly, collecting and shipping tumbleweeds globally for film sets. Now, while this business was undoubtedly very active and hands-on initially, you got to go collect those things.
Right, chasing tumbleweeds.
If he successfully scaled it, hired others to do the collecting, preparation, logistics, it could eventually transition into a much more passive income stream for him as the owner overseeing the operation.
Interesting. Then there are the more unusual anecdotes of people getting paid just to nap or simply be present.
Yeah, think of sleep guards mentioned in one source, or individuals paid simply to be present overnight in an empty building for insurance purposes, or even just to stay with an elderly person, essentially being on call but maybe sleeping most of the time. Someone even mentioned being paid to regularly flush all the toilets and start the engines of luxury cars for super rich people who owned multiple homes they rarely visited, just to keep everything in working order. These are certainly unusual jobs, but they are definitively active. They require your physical presence and your time. They're absolutely not passive income.
Right, you have to be there. And in the digital realm, we frequently encounter what the sources sometimes call selling air examples. Things like manifestation coaches or certain types of Instagram gurus.
Exactly. These are individuals who often sell high-priced online courses, exclusive event spots, or golden tickets, promising things like self-actualization, rapid business success, or manifesting wealth.
Right, big promises.
Big promises. Now, while the initial content creation, the course videos, the guides might be a one-time effort, making it technically scalable, they undeniably require continuous active effort. They have to constantly attract and engage followers, cultivate a strong personal brand, market their offerings, and secure new clients or brand partnerships. It really illustrates that often blurred line between passive potential and active reality in the modern digital economy.
There are also these highly niche online services that blur the lines. One source mentioned a feet pick broker.
A what?
A feet pick broker, someone who apparently managed accounts and handled direct messages for individuals selling pictures of their feet online, taking a cut. So they weren't creating the content, but acting as an active intermediary, a manager.
Wow, okay, that's
Very specific. Or someone who profited by buying pallets of undeliverable UPS packages at auction and then reselling the contents online. That's basically an active retail flipping model.
Yeah.
Just with mystery goods.
Right. The hustle is finding and sorting the goods.
Some of these examples also raised ethical concerns, didn't they?
They definitely did. Like the story of a scam business that promised to connect people to high-paying jobs but ultimately failed to deliver after taking fees, or that somewhat infamous example of an atheist group that reportedly charged concerned Christians money for post-rapture pet care, promising to look after their animals after a predicted and obviously failed apocalypse.
Yikes.
Yeah. These highlight that not all hustles or unconventional money-making schemes are created equal, either morally or practically. Some cross the line into outright deception or exploitation.
Which leads us directly into a very important and frankly sobering discussion, the stark, dark side of wealth generation. This involves outright fraud and systemic corruption. And let's be crystal clear. These are precisely what legitimate passive income is not.
Absolutely not. It's the antithesis. Our sources report a really startling statistic, a 38% increase in reported fraud in the Netherlands alone in just the first half of 2024. Resulted in 53 million in known damages, much of it driven by sophisticated investment fraud scams and increasingly convincing fake bank help desks, tricking people into giving up access.
That's terrifying.
It is, and these are not passive ventures by the criminals. They are highly active, often complex criminal enterprises diametrically opposed to genuine, value-creating passive income. They are designed purely to extract wealth through deception, not generate it through legitimate means.
We see these recurring high-profile financial crimes too, like Ponzi schemes. They're essentially pyramid schemes where early investors are paid off with funds collected from newer investors until the whole thing inevitably collapses.
A particularly egregious example mentioned was the forward gold sale fraud in the Netherlands, where around 600 investors were duped out of an estimated 30 to 45 million, promised huge returns on gold that didn't really exist in the way they thought.
And what's even more concerning there, banks like ING and Bunk are now actually being sued by victims for allegedly failing in their gatekeeper role, basically, for not detecting and reporting these massive suspicious transactions flowing through their accounts. It highlights potential systemic vulnerabilities.
Then there's the sheer scale of crypto fraud we've seen. Obviously, the infamous FTX scandal stands out, where Sam Bankman-Fried was convicted of stealing $8 billion from unsuspecting customers who trusted his platform.
Just staggering.
It highlights the extreme risks and the purely criminal nature of some operations within the less regulated parts of the crypto world. Another sobering example was the arrest of an Amsterdam-based developer of Tornado Cash, which is a crypto mixing service designed to obscure transaction origins. He was accused of allegedly facilitating $1.2 billion in money laundering through the service. It underscores how even seemingly neutral technology can be weaponized for illicit gains on a massive scale.
And corporate fraud is also rampant, operating sometimes on an unbelievable scale. Volkswagen's Dieselgate scandal, remember that?
Yeah.
It resulted in over $32 billion in fines and costs globally due to their deliberate deception about vehicle emissions.
Or Steinhoff, the global retailer, which was embroiled in a massive $6 billion accounting fraud that nearly destroyed the company. And more recently, René Benko, the Austrian real estate magnate behind the huge Signa empire, stands accused of diverting funds and misleading investors, leading to claims of around $2.4 billion as his empire collapsed.
It's not just the billionaires either, right?
No, absolutely not. There are smaller yet equally egregious cases mentioned, like a financial manager embezzling over $1 million from a funeral services company called Yarden, or a hospital director from the Slotervaart Hospital who embezzled $1.2 million. These aren't passive income streams. These are active, deliberate acts of theft and betrayal of trust.
The problem then extends even further into organized crime and global corruption, showcasing illicit wealth accumulation on a truly staggering scale.
Yeah, our sources listed some notorious figures. Top criminals like Semyon Mogilevich, allegedly a major figure in the Russian mafia, estimated to have amassed perhaps $10 billion through activities like arms dealing, complex fraud, and money laundering. Or Meyer Lansky, the legendary financial mastermind behind much of the American mafia's operations in the 20th century, with an estimated fortune, adjusted for inflation, perhaps around $4 billion.
These weren't passive investors.
Not remotely. These individuals amassed their fortunes through systematic illegal means, bribery, extortion, trafficking, controlling vast illicit networks. It demonstrates highly active criminal enterprise, the polar opposite of legitimate income generation.
And the global corruption examples are just everywhere. They truly span continents, illustrating how deeply embedded these problems can be. In Europe, we've seen the Qatargate scandal and investigations into Huawei lobbying in the EU Parliament, involving alleged bribes and illicit influence peddling, directly undermining democratic processes.
There's also that ongoing investigation into the EU's massive vaccine purchases, focusing on missing text messages involving European Commission President Ursula von der Leyen, raising serious transparency and accountability concerns. We saw the Ndrangheta Mafia, the powerful Italian crime group, reportedly smuggling 22 million Eurotats worth of cocaine and laundering the proceeds through legitimate-seeming businesses across Europe. Even major corporations aren't immune. Ericsson, the telecom giant, reportedly paid potential bribes, possibly even to ISIS affiliates, to gain market share in Iraq.
And it just keeps going around the world, doesn't it?
It really does. Chinese officials accused of stealing valuable trade secrets from ASML, the Dutch chip machine maker. A Chinese bank CEO sentenced to death for taking $134 million in bribes. Japanese cabinet members caught concealing political donations. In Africa, Glencore, the huge commodities trading firm, had to pay $1.3 billion in settlements for a widespread campaign of bribing government officials across Africa and South America to secure favorable deals. A former U.S. diplomat was even charged with secretly spying for Cuba for over 40 years. Stephen Bronfman, part of a wealthy Canadian family, allegedly involved in diverting millions offshore to the Cayman Islands, potentially avoiding taxes. Vijay Mallya, the Indian tycoon, convicted in absentia for $1.4 billion in fraud and money laundering related to his failed airline. The former president of Georgia sentenced for embezzlement. The daughter of a former president of Uzbekistan fined $1.6 million for bribery, using a complex web involving a shell company and Dutch financial services to facilitate it. Even the Prime Minister of Portugal resigned amidst ongoing investigations into alleged bribery related to lithium mining concessions.
And even closer to home, in the Netherlands, the sources highlighted ongoing issues. Things like money laundering via the purchase of luxury goods, like Louis Vuitton bags, for the Daigou trade back to China, where individuals buy goods abroad, often exploiting price differences or avoiding import taxes, and resell them back home, sometimes used as a channel for illicit money flows.
There's also organized crime reportedly using holiday parks, those bungalow parks, for money laundering activities. And disturbingly, a tax official was linked to providing information to Ridwan Taghi, one of the country's most notorious criminals. Even regulatory bodies aren't immune. The Dutch Food Safety Authority, NVWA, was criticized for failing to adequately control widespread meat fraud.
Okay, the clear, unequivocal takeaway from all of these deeply disturbing examples is that these activities are not passive income in any legitimate or ethical sense.
Not even close. They are highly active, often ruthless, frequently violent, and always illegal ways to accumulate wealth. They come at a massive societal cost, eroding trust in institutions, causing widespread harm to individuals and communities, and undermining the rule of law. They starkly illustrate the critical, fundamental difference between genuine, value-creating wealth generation through investment or enterprise and purely extractive criminal activity that profits from deceit, coercion, or corruption.
Building on that powerful warning, our sources also offer a really profound societal perspective on wealth itself, particularly critiquing extreme wealth concentration. One viewpoint, notably coming from a source titled Abolish Billionaires, argues quite provocatively that extreme profits are often derived not primarily from meaningful contribution or brilliant innovation, but simply from the act of owning assets.
That's a really profound point that definitely challenges conventional narratives about wealth creation. Examples provided include landowners who benefit immensely, passively, when public investments like new subway lines or parks built with taxpayer money happen to raise the value of their nearby property. They didn't build the infrastructure, but their asset value skyrockets.
Like they just own the land.
Exactly. Similarly, tech billionaires are often cited in this critique as profiting enormously, not just from their initial innovation, but from the ongoing state-granted intellectual property protections, those patents and copyrights we discussed. These are, in essence, government-backed monopolies that allow creators, or more often the corporations they lead, to control and profit exclusively from their innovations for extended periods. This perspective questions how much of their resulting wealth is purely a reward for individual genius versus a consequence of this favorable legal framework.
And inherited wealth is frequently brought up as the prime example of unearned advantage in this particular context. Charlene de Carvalho Heineken's inherited billions are presented as vast fortunes acquired with absolutely no contribution or effort on the part of the recipient.
It's seen as wealth bestowed purely by lineage, by the accident of birth, not by personal striving, risk-taking, or ingenuity.
And this perspective ultimately argues what? What's the conclusion?
It argues that the very existence of a billionaire class, characterized by such extreme wealth concentration, can actually damage society. It suggests this happens through fostering economic inefficiency, enabling disproportionate political influence and potential corruption, harming democratic processes by concentrating power, potentially hindering broader social progress by locking up capital, and fueling social unrest due to these stark, visible inequalities.
So it's a call for change.
Essentially, yes. It's often a call for policies like a progressive wealth tax, higher inheritance taxes, or even a conceptual wealth limit aimed at reducing this extreme inequality. The argument sometimes made is that society is already effectively dispossessed by this class, perhaps through mechanisms like unrewarded labor contributions or the unchecked commercial exploitation of personal data generated by the masses. It forces us to ask really tough questions about the fundamental mechanisms of wealth creation and distribution in our modern world.
Okay. On a more perhaps empowering note for the individual listener, and shifting our lens a bit, our sources also emphasize the profound importance of the follow the money principle.
Ah, yes. Classic advice.
They suggest that gaining a deeper understanding of money itself and the often complex financial systems that govern our world helps you better comprehend which parties and organizations truly influence your life. It's about pulling back the curtain, isn't it? Seeing how power and influence often operate behind the scenes, recognizing that financial flows frequently dictate real-world outcomes and policy decisions.
Absolutely. The principle, follow the money and you will find the truth, is presented not just as, a detective's cliche, but as a fundamental way to gain a deeper, more informed understanding of how the world really works.
It connects the dots.
Exactly. It links financial literacy directly to broader societal insights. It implies that achieving true personal freedom, exercising informed citizenship, often begins with developing that financial understanding and cultivating a critical awareness of the underlying economic structures and incentives that shape our daily lives, our opportunities, and our societies.
And there you have it. Wow. We've taken a really comprehensive deep dive into the incredibly nuanced, often contradictory world of passive income. We've explored everything from those established investment strategies and scalable digital ventures all the way to the truly bizarre ways people find income, and even the deeply disturbing illicit ways people chase wealth.
What truly stands out, I think, from synthesizing all our diverse sources is that genuine, sustainable passive income almost always demands significant upfront effort. It requires meticulous planning, smart, ongoing strategy, and often a healthy dose of patience, rather than being some kind of effortless overnight free ride.
Right. Whether your personal goal is to achieve true financial freedom down the road, maybe just cultivate some much-needed breathing room in your monthly budget right now, or simply find intelligent ways to pad your bank account, understanding these critical distinctions is absolutely essential.
hmm The distinctions between genuine passive income that requires that upfront work versus active hustles that might become passive if scaled versus the undeniable role of sheer luck sometimes, and crucially, versus outright fraudulent schemes designed to steal, not create.
It's really about making informed choices, isn't it? Building wealth in a way that aligns with your personal values, your tolerance for risk, and maybe most importantly, your genuine willingness to put in that vital upfront work.
So, here's a final provocative thought to leave you with. In a world where we see some individuals get rich from inventing something as simple as a tissue fold, while others inherit billions without lifting a finger, and still others resort to incredibly complex global fraud schemes that cause immense societal damage. What does that truly tell you about the varied, sometimes unsettling engines of wealth in society today?
And perhaps on a more personal level looking forward, what kind of upfront work are you willing and able to commit to for your own financial freedom and the future you envision for yourself?